We are currently in one of the best times of our lives to get rich through investments right now. As the market has dipped in the last 6 months, there is our chance to 2x, 3x, or even 5x our net worths if we know how to take advantage of it. As Warren Buffett has said, be fearful when others are greedy and be greedy when others are fearful. But buying alone in this recession is not enough. You need to choose investments wisely as well. In this recession, Warren Buffett, known for his value investment success, together with other investors such as Charlie Munger, Ray Dalio, Bill Ackman, and Michael Burry, as well as other investors, have been doing some shopping when businesses are selling at great discounts. And if these super investors are buying, maybe we can learn a bit or two from them. Fortunately, thanks to Danaroma, we can look into exactly what investments that these super investors made. And that's exactly what we'll be going through in this video. The top 3 value stocks that I think are worth looking into that the super investors made in the past few months. Now, let's start with the first value stock that our super investors have chosen, with 26 super investors buying it. That is Meta, the world's largest social media platform. Meta, as we all know, is composed of 3 core businesses, being Facebook, Instagram, and WhatsApp. And as of Q4 2021, Meta's earnings is at $39.37 billion, a 35% increase from 2020. With such high earnings as well as market shares from its businesses, Meta is obviously a mature but still growing and a very reliable company. And its financials show this. Earnings have been growing at a rate of 30% in the last year. FCF, or free cash flow, has also been very consistent, growing at also a 30% 5-year average. These are also complemented by other fantastic metrics, such as the PE and PB ratios, both currently at their 8-year low of 13.95 and 3.61 respectively. And these numbers are ridiculous for a tech company like Meta, showing just how cheap it's selling at right now. And besides, from the multiples Meta is selling at, it also delivers great return as well, with the ROIC of 23.13%, with every year in the last 6 years being above 20%. This consistency also delivers and translates to ROA of 19.76% and ROE of 25.48%. And this consistency continues. Its current gross margin is at 82%, and it's been above 80% in the last 8 years. How crazy is that? And then also its net margin right now is at 23.20%. And besides from its performance, Meta also has a very healthy balance sheet, with its current ratio all the way at 2.52 and its DE ratio at only 0.13, a very modest ratio for the company compared to other competitors. So this means we have more capacity to borrow, and it also means that we have the ability to deal with headwinds if they ever arise. So overall, Meta is a solid business, but its stock price is not telling the same story. Currently, its stock price has dropped 60% year to date. But this doesn't mean Meta's businesses have become 60% worse. It still has a very strong moat, with its market share currently at 40%. The main reason why there's been such a drastic fall in the share price is because recently, Facebook has reported that they've seen for the first time a fall in the active user base. And also adding to that is the competitiveness from TikTok as well as YouTube in the social media world. However, in the end, even with some headwinds facing Meta, it still is a very strong business, especially with the recent diversification into the metaverse with its acquisition of Oculus. So in the super investors' eyes, Meta is probably a very prominent business to invest in for the long run. So that's Meta. And now, the second stock that we are going to talk about is Google, the world's biggest search platform, comprising of Google, YouTube, and Google Cloud Platform as its main income sources. Specifically with its Google search engine and network comprising of 73% of all revenue, YouTube ads 11%, and Google Cloud at 7%. But take a look at this. In the last 8 months, Google has dropped to as low as 30%. However, at the same time, 17 super investors have bought Google in the last 6 months. And while the current price is not at an extremely discounted level, it still brings the company to a fair price. Or as Warren Buffett would put it, It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Looking at Google, it has great fundamentals as well. Earnings has been increasing and growing year by year consistently at an average of 55%, with free cash flow also growing in the last 5 years. This is expected by the market to keep increasing for a total of 60% by 2025. So Google is definitely a cash flow machine and a great business at a great price currently, with its PE ratio at its lowest in the last 8 years of 22.30, a return on invested capital of 26.41%, second highest return ever recorded, with extremely high liquidity and low debt. All of these really lower the risk of owning and heightening up the potential reward that Google can bring to its owner. Furthermore, looking ahead, Google has great potential immersing in the cloud computing industry with its Google Cloud platform. Cloud computing is already expected to grow significantly by 20% in the upcoming year, and you can already see it happening around you. People using Google Drive, OneDrive, and iCloud, and businesses storing all their information on the cloud currently. So overall, it's really a no-brainer why Google is on the list of so many super investors. So that's it about Google. Now we move on to our third stock, being Alibaba, China's biggest e-commerce platform. Now if you've been living under a rock and don't know what Alibaba is, I'll give you a quick rundown. So Alibaba is the third biggest company in China by market cap, and it owns the biggest e-commerce businesses including Taobao, Tmall, AliExpress, Alibaba, Lazada, one of the biggest payment systems in China called Alipay, and also owns a major cloud computing player called Alibaba Cloud. While Alibaba seems like a conglomerate, its major revenue is still from e-commerce, both retail and wholesale at 87%, followed by cloud computing at 8% and others at 5%. And last year alone, the company has earned a staggering $133 billion in revenue. And with so many companies being at the top of their games, Alibaba definitely has a very strong moat. Being one of the most influential companies to China's economy, they have 891 million customers on their platforms in China alone, $1.2 trillion in gross merchandise volume, with 1.3 billion active users on their payment system Alipay, responsible for a whopping $17 trillion worth of transactions in China last year. However, when you look at the price of Baba, it's fallen by 71% in the last 2 years, gathering interest from a lot of super investors such as Charlie Munger and Mohnish Pabrai. And it makes sense how Alibaba attracts these investors. Up until last year, earnings and free cash flow have been increasing year by year. And the reason for the reduction in earnings last year are the slowdown in revenue and losses from investments, with revenue dropping by 2.5% for the first time since listing on the New York Stock Exchange, and earnings from investments going from $11.85 billion to negative $2.55 billion in just a matter of 2 years. And this all happened as a result of COVID market condition, risk of delisting, as well as the China tech crackdown. And while these risks are well known across all super investors, it seems that they see these returns for the risk that they are taking are justified. Or as Mohnish Pabrai would say, heads I win, tails I don't lose much. It's clear that the investors such as Mohnish Pabrai are optimistic that the negative conditions will improve and will not sustain for a long time, and that the risk to return ratio is at a comfortable level. This investment mentality has been demonstrated through a high PE ratio of 51.05. However, if we use the current pricing and compare it with Baba's normal year earnings, we get a PE ratio of 11.12, the lowest ever recorded. And I believe this is how the super investors see it too, especially when Baba is backed by a giant moat, as mentioned before. This is further shown by Alibaba return on invested capital before COVID of 15%, consistently above 10% in the years before that, with fantastic balance sheet of low debt and high liquidity as well. So overall, when it comes to investing in Alibaba, it's all about investing in the long run and the compounding effect. And we cannot neglect the potential that the cloud computing industry can have, especially with Alibaba Cloud as a major player in that field. And that's it, guys. That's the top 3 value stocks that the super investors have been buying in the last 12 months.